One of the most notable trends in modern finance has been the spectacular rise of passive investing. Today, trillions of dollars are being invested in index funds and exchange-traded funds, ETFs, that seek simply to replicate the performance of market indices rather than outperform them. The traditional asset management industry was the domain of active managers who performed research, analyzed financial statements, assessed management quality, and estimated future earnings in an attempt to identify mispriced securities. Their trading activity was a major factor in the process of price discovery, helping ensure that market prices reflect available information. Passive investment bypasses the role of the active manager. Instead, passive investors are essentially price takers and make no judgment about the intrinsic value of individual companies. A passive fund buys securities because they are included in an index, and not because portfolio managers believe those securities are undervalued or offer superior future returns. On the face of things, the passive investing proposition would seem to have little to recommend it. However, that is before taking into account the substantially reduced fees charged on passive funds compared to their actively managed counterparts. Furthermore, proponents of passive investing have a credible argument that active managers as a whole can never beat the market. Therefore, their efforts as a group are futile. The reason for this is that if markets already reflect available information, as advanced by the theory of efficient markets, it becomes impossible to consistently outperform the market, particularly after fees and trading costs are extracted. While the most important factor behind the rise of passive investing is cost, even seemingly small reductions in annual costs can have a substantial impact on long-term investment returns through the power of compounding. Passive investing has other advantages. Passive funds provide broad diversification. Rather than relying on the performance of a small number of individual companies, investors gain exposure to hundreds or even thousands of securities through a single investment. Passive funds are transparent. Because index methodologies are publicly available, investors generally know exactly what they own and why. Finally, passive investing removes many of the behavioral pitfalls associated with active investing. Investors are less tempted to chase short-term market trends or make frequent trading decisions based on emotion. But market commentators now believe that the very success of the passive investing strategy threatens many aspects of how markets themselves operate. They contend that rapid expansion of passive investing could have unintended consequences for market efficiency, price discovery, corporate governance, and financial stability. Because passive investors are price takers, where the strategy dominates at the expense of active investors performing analytical work on individual securities, can the markets still be said to be efficiently priced? Concentration risk threatens market stability. Most major equity indices are weighted according to market capitalization, meaning that larger companies receive larger index weights. As successful companies grow, passive funds automatically allocate more capital to them. The consequence is that a larger allocation of additional money flowing into index funds is directed towards the largest companies in the index. This has contributed greatly to the growing dominance of a relatively small number of large technology companies in many equity indices. So while investors in passive funds may believe they have a well-diversified portfolio, in fact, their returns are dependent on an increasingly small number of companies. Related to that, critics of passive funds believe that large index funds could amplify market movements in times of market stress. The growth of passive investing has also altered patterns of corporate ownership. A relatively small number of global asset managers now hold significant ownership stakes in many of the world's largest public companies through their index funds. But passive managers cannot easily sell underperforming companies without deviating from their benchmark, so they increasingly rely on corporate engagement and proxy voting to influence management behavior. This has expanded the importance of stewardship activities, including voting on executive remuneration, board appointments, climate-related disclosures, and governance practices. Some observers argue that concentrated ownership may strengthen long-term corporate oversight. Others question whether a small number of asset managers should wield such significant influence over corporate governance decisions. Ultimately, passive and active investing will live with each other. Passive investing provides efficient market access, delivering enormous benefits to millions of investors through lower costs, greater diversification, and improved long-term investment outcomes. Active investing retains a critical role in price discovery and capital allocation.